name is Richard Forden. I'm with the Carter University team. And today we're going to talk about options for purchasing CAT machines. Today our presenter is Donna Ashbrook. You know, when we're talking about all the different options, it can seem confusing on the surface, but Donna has done a really good job of showing us the ins and outs of each type of purchase. So want to thank Donna for joining us, and thank you all for joining us.
Okay, thank you, Richard. Today we want to talk about options for purchasing a CAT machine. As we walk through it, I'll talk about each option and then we'll explain more as we go through the presentation. So obviously when you purchase a CAT machine, you can pay cash by, paying for the machine when we deliver it by check or certified funds. Also, if by credit approval, we can invoice you for the machine on a net 10-day basis. Also, we can utilize finance options that I've stated below, and my team will help the salesman and you through the financing options if you would like us to, either with CAT Financial, which is our captive finance source, or we have some bank partners as well. The first purchasing option would be an installment sale agreement. That's just a regular loan that you could get with your bank or anywhere you go. A finance lease goes into our leasing options. Flex lease, which is more the finance leases or capital leases are called in some areas. CAT value option and a long-term rental. The CAT value option and a long-term rental are our operating leases, or sometimes you'll hear them called long-term rentals. Okay, so when we talk about loan versus leases, when the customer is looking at loan versus a lease, what they're going to see is the loan has a higher monthly payment. They're paying for the entire purchase price plus interest and taxes over the term of the loan. The title transfers at the end of the contract. The purchaser has risk of ownership, and there's a lower cost to own the equipment. Under a lease, you're going to get a lower monthly payment. You're paying for the rent and the lease payments and charges and taxes. You're paying for the use of the machine. There's no automatic title transfer. Leaser has risk of ownership, and there's a higher cost to own the equipment. So lots of customers look at leasing, and the reasons they look to lease is to manage their cash flow, to manage their tax position, expense payments rather than interest expense and depreciation. They better match their revenues with expenses. They align their lease term with the length of the specific project. So a lot of customers, if they have a 2-year project, they're going to be looking to do a 2-year lease to control those expenses with the project. Fleet management, they rotate their equipment in every 3 years, 4 years with no risk costs associated with disposal. So every 3-4 years, some customers 2 years, they're looking to flip that equipment into new pieces and just turn the equipment in. Leases have 100% financing. There's no down payment requirements. Operating lease treatment excludes obligation from the balance sheet. It enhances financial ratios such as return on assets, and it shifts risk and burden of ownership to the leaseor. So let's talk about the comparisons of retail finance products. Under the installment sale contract, this is for the customer who desires immediate ownership yet wants to pay for the machine over an extended period of time. On a finance lease, for the customer who wants to own or have the option to own the equipment under a lease structure. A finance lease could be a finance lease with a dollar option, or you could have a purchase option on the back end of the finance lease to lower their payment. The flex lease is a version of the finance lease, and that's for the customer who wants a finance lease with the option to return the equipment at stated intervals prior to lease termination. We'll go into this a little bit more on the next couple of slides. Now, if we go into operating leases, I'm using the CAT Financial leases as an example, but there's versions of these at our bank partners and at the customer banks as well. CAT Financial calls it a CAT value option lease. This is an operating lease for the customer who wants to own the equipment and have the option to purchase it at a predetermined fair market value price. So as we go into the lease, the customer wants to use it as an operating lease, be able to expense their payments, but they also want to know what they can purchase the machine at the end of the term. So Cap Financial or our bank partners will put a predetermined price at the end of that lease. Also under the operating lease, there's a long-term rental that basically at the end of the lease period, instead of a predetermined price, it's a fair market value option. What that means is at the end of the term of the lease, Cap Financial or our bank partners will determine what the fair market value of that machine at the end of the lease will be, and that will be your purchase option. So as you see at the bottom of the screen, loan is a lower way to have ownership costs, and as it moves across the screen, leasing has a higher ownership cost because generally leasing has lower payments. It's going to have a purchase option at the end, and generally the intent on the leases are not to own the equipment. To continue our comparison of retail finance products, characteristics of each product. On an installment loan, accounting classification, it is a loan. The tax classification, it is a loan. The ownership is by the customer. The tax depreciation is by the customer. Customer takes the depreciation on the piece of equipment. Equity build-up, customer owns the piece at determination of the loan. The monthly payment is a little higher. The cost of ownership is lower. There is no purchase option. Usage restrictions are none. There's no early payoff restrictions, but there is an early payout fee of $275 with Cap Financial, but with our bank partners, it may be a little bit higher. Personal property tax, customer pays the personal property tax direct to the county that's invoicing them. I didn't put it on here, but also on insurance, there are insurance requirements for an installment loan contract. Cap Financial or our bank partners will need to be listed as loss payee. As we go into a finance lease, that in the world of financing, you'll hear it either called capital lease or finance lease. The tax classification is a non-tax lease. The ownership is by the customer. The tax depreciation is by the customer. The equity buildup is some is expected at termination because your payment is a little bit higher than a installment sale contract, but a little bit lower than an installment sale contract, but a little bit higher than an operating lease. As we look at total cost of ownership, it's lower under an installment sales contract. Goes a little bit higher on a finance lease, and it's the highest at an operating lease because really the intent is to use the equipment, not own it. Purchase option, there's none on an installment sale contract. On a finance lease, there's a bargain purchase option, which makes it a finance lease. There's accounting rules in reference to a finance lease and an operating lease. So a finance lease is going to have a lower purchase option, but an operating lease will have a higher purchase option to make it qualify as an operating/tax lease. Usage restrictions. Obviously, there's none on an installment sales contract because the customer is the owner. On a finance lease, the customer is the owner still, but there is a purchase option at the end of it. So there are some usage restrictions there because the customer can return the machine if they choose to. Under those restrictions, it's reference to the number of hours the customer uses the machine. It's also reference to an application survey that states in it how the machine is to be returned. Early payoff restrictions. This is on straight amortization, so there's no early payout restriction, but you still will have an early payout fee. Cap Financial $275. Our bank's a little bit higher. Personal property tax. Customer still pays the personal property tax direct. And insurance requirements, because this is a lease, it will be that Cap Financial is listed as loss payee and additional insured. As we move to an operating lease, the accounting classification, it is an operating lease/tax lease. The ownership is by Cap Financial. The tax depreciation is taken by Cap Financial. There's no equity expected at termination because your payments are lower, and truly the intent is to use the equipment. As you move to the monthly payment, and under an operating lease, it has the lowest payment. So then therefore, because it has the lowest payment and a higher purchase option, the total cost of ownership is going to be highest. The purchase option is residual set at expected fair market value, or with a you can either have a fair market value purchase option or a stated option under the cap value option. Early payout restrictions. Because this is an operating lease, there are some early payout restrictions. It has to be approved by Cap Financial, and actually it's not on a straight amortization. When you pay it out early, it's the casualty value price or fair market value, whichever is higher. Personal property tax. Cap Financial is the owner, so the county invoices Cap Financial direct. Once Cap Financial gets that invoice, then they're going to automatically re-invoice it to the customer. They normally do that once a year, starting January the 1st. And insurance requirements, there again, Cap Financial would be listed as loss payee and additional insured. Richard, I'm going to need some help. My screen's not moving. Okay, there we go. Okay, so I wanted to give you an example of what I was talking about, is talking about cost of ownership. What I'm going to use, it is the Caterpillar D5K2 LGP as an example with a sale price of $219,300 on a 60-month term. Now, this is under a national program, so actually it has zero interest on the installment sales contract. If we were actually dealing with a machine that was not under a program or a little bit higher interest, these numbers would be even greater. But as we walk through this D5K, on an installment sales contract, the monthly payment is $3,655. A finance lease, excuse me, let me get down the installment sales contract, monthly payment $3,655. We're doing it for 60 months with zero interest, so that total payment is $219,300 with no purchase option. So the total cost to own there is $219,300. As we move to a finance lease, because we're carrying a purchase option of $56,320, that's going to make the interest go up a little bit higher. I think it's right around 1.09. So your payment, though, is lower because you have the purchase option. So under a finance lease, your payment is $2,824. For 60 months, the total payment is $169,440 with a purchase option of $56,320. So if you wanted to purchase that machine at the end, exercise your purchase option, your total cost to own would be $225,760. So it's a little bit more than installment sales contract. As we move over to the operating lease, this is where your lowest payment is. Your payment is $2,616 for 60 months. Your total payments is $156,960 with a purchase option of $73,920, making your total cost to own at $230,980. So what I want to bring to your attention here is, what is the customer's really, what is your intent? Do you want to own the equipment? Are you not sure? Or do you just want to use the equipment? Because I want to point out the total payment. So obviously, if you just want to use the equipment and return the equipment at the end of the lease, my suggestion would be to go to the operating lease, because your total payment is $156,960. compared to the finance lease at $169,440 or the installment sale contract at $219,300. But if your intent is to own it, to own the piece of equipment, obviously installment sales contract is the way to go. If you're not sure, you have some work that's going to make through the next 5 years, but then you're not sure what you're going to do from there, but you might want to own the equipment, I would suggest the finance lease. We also have the flex lease that I'll go through in a minute that might even be a better option. But if you just want to use the equipment, it matches to a job, you have a 5-year job, let's say you had it, if this was 3 years, 3-year job, and you were just using the equipment, you would turn it back in. So always you would be looking at the potential of just using the piece of equipment, and an operating lease would potentially be the way to go. Okay, so this is an example of an actual payment stream: installment sale contract, finance lease, flex lease, cap value option, long-term rental. To compare, I used 24 months and 60 months. The reason being is because what I did with the flex lease was a 60-month lease with a 24-month out. I'm going to leave that to the last to explain. So under installment sale contract for 24 months, your payment is $9,137.50. As you move to the finance lease, your payment drops to $5,327.50, but you have a purchase option of $91,440. As you move to the cap value option, this is our operating lease, but it has a stated option at the end of it. Your payment is $4,375, and you have an option to purchase at the end of it of $120,015. In the long-term rental, the payment is the same, but you take the risk of not knowing what your purchase option is going to be. So if I had the choice between the two of those, I would want to make sure I knew what my purchase option was, so I would make sure I had a stated option at the end of it. As we move to 60 months, and this is where a lot of customers land, 48 and 60, our payment is $3,655 for an installment sale contract. There again, that's going to be the lowest cost to own. A finance lease is $2,823.65 with a purchase option of $56,320. As we move over to the operating leases, the cap value option and long-term rental, your payment is $2,615.82. You have a purchase option of $73,920, or same, you have a long-term rental at 60 months at $2,587 with a fair market value option at the end of it. I still would go with that purchase option stated there, even though the payment is just a little bit higher, just so you would know what your stated option is. But as you can see, in those two the operating leases, the payments are lower, but where we have had success and customers really like is what the flex lease, because you can structure it to have as many outs in it as you want. So we structured it as a 60-month lease, but the customer had a job for 2 years. So he wanted, the option to be out of the lease in 2 years if he had to, but have the potential if he still had work and he wanted to use the machine up to 5 more years and decide if he was going to purchase it. We structured a 24-month out. So customer now has a payment for the first 24 months at $4,375, which matches to the CVO and long-term rental. So he still has the lowest payment for that 24-month period. And then as he moves into the 25 to 60-month period, he has an even lower payment at $1,659, and then has a purchase option at the end of it to determine if he wants to keep the machine or not. So we're doing what he needs, or the customer's doing what he needs. He has a job for 24 months. We structured it to have him a payment, the lowest payment he could get for the first 24 months. And then if he wants to continue to use the machine, he has the option to have an even lower payment from 25 to 60 months, and then decide from there if he wants to purchase the machine. Okay, that's the end of my presentation. I want to open up to questions. Does anyone have any questions?
Donna, this is Richard. I guess quick question. If we have a customer that's interested in looking at the cost of their machine and multiple different options like this, Do they talk with their salesman? Do they have to talk with someone in the finance department? How does that system work?
The salesman would be the first point of contact. Generally, the salesman is going to bring the finance team in. If the customer wants to talk to the finance team, that's absolutely fine. Sometimes we even bring in our CAT Financial rep. But yes, the salesman will be the first point of contact, and then we work together as a team to decide the best option.
Great. Does anyone have any other questions? All right. Well, thank you so much, Donna. I really appreciate your time today, and thank you to everyone who joined in on the call. We appreciate your time and your business with Carter Machinery. As always, if you have questions, feel free to drop us an email at shoptalkchannel@cartermachinery.com, and we'll make sure we get your email to the appropriate person who can answer your question. Thank you again for joining. Hope you enjoyed today's session. Thank you, Donna, for the hard work you put into this presentation and making a complex thing like buying a machine into something that's relatable and understandable. So thank you for that. And thank you all for joining us. Hope you have a good afternoon.